right. So, hi everyone. For those of you who don't know me, my name is David Chu. I'm one of the pulmonary critical care faculty here. And as part of the personal finance series today, we're going to be talking about the basics of long-term investing. I always start by all these talks by saying, mentioning that I don't have any financial disclosures. I think this is really critical if you're talking about trying to get advice from someone about how to invest your money. Because the question always has to come up, similar to why you look at financial disclosures for reading a study, is what's their motivation for doing this? My motivation is to try to improve education around financial literacy, and also I guess I enjoy the sound of my own voice, but but otherwise, I don't own stake in a specific company. I don't provide financial advising services at cost. I don't, regardless of what financial decisions you make after this, I don't reap any benefit from it. So I'd like to think I'm about as objective as you can get on this topic, but you always should take a grain of salt with any sort of financial advice you get. And I would really encourage you all to continue to read on your own, to do your own research on this stuff so that you can be well informed as you make these decisions. And another thing I always try to point out is that personal finance is very personal. Now, this topic in particular, I think, depending on your risk tolerance and all of that, there are some decisions that you have to kind of make for yourself. But hopefully, I think the general principles here kind of apply regardless of the specifics of your financial situation. But at the end of the day, you need to get the information and make your own decisions about this. If you want to hire advisors, if you want to look for advice, that's fine. But you can't expect someone else to do all this for you. They should be there to advise you, as their name implies, and not to do the work for you. You should be aware of what's going on, why it's happening, and agree with it based on that. So. Here's what we're hopefully going to cover today. We're going to talk about what exactly are stocks, bonds, and mutual funds, because those are probably the most common investment vehicles that you'll be using as the bulk of your portfolio when you save for retirement. Talk a little bit about the relationship between risk and return. Try to convince you that a passive index-based approach for long-term investing is superior to stock picking and active management strategies. And hopefully through the course of this, if you don't know what any of that means, this will make a lot more sense later. And then use this information to kind of draft a basic investing statement. So I think the reason that we have to talk about this is that this is intrinsically linked to the ability to retire. Now, I assume that most people who come to these talks probably have somewhere on their heads that they'd like to not work one day. And to be able to do that, you essentially need to have enough money such that you can live off of it and not have to work for income, right? Now, the problem is that back in the day, a lot of jobs used to offer pensions, and those don't generally exist, particularly in the medical field these days. Social Security for someone who's used to a physician income is unlikely to be enough. Savings accounts are certainly not keeping pace with inflation. Right now, the spread is, the average high yield savings account is still offering about 0.5% interest rate, while inflation is currently at 7%. So putting your money in a savings account is losing money over time right now. More so than typical, but in general, that's always the case. And so if you don't take advantage of investing and the returns that you get by investing your money, you would have to save 3 to 4 times more than you would otherwise. And often it isn't really practical to kind of accumulate the kind of wealth that you need to retire without investing as part of your strategy. And so I bring this up just to say that, in medicine, we're kind of all behind the 8 ball by definition. If you compare to people who started investing during at the beginning of their working careers when they graduated, say, high school or even college, you start graduating college, you put away $5,000 a year, and that makes you like this person here, where you start investing at the age of 25, you invest $5,000 a year, and you end up with 1.1 million after 40 years. Even if they stopped investing after only 10 years, they'd still end up with 600,000 if they never touched it again. However, we're sort of over here. We're in the starting in our late 20s, early 30s category, kind of depending. And so even saving all the way between 35 and 65, you can't make up for that lost time by just saving the same amount. The only way to get from point A to point B here is that you have to save more than the guy who started earlier. But the other point to keep in mind here is that if you want to get here and you don't take advantage of investments, so this assumes like a 7.5% growth rate on your investments each year. To get to the same number, you'd have to save $19,000 a year if you had a savings account that was paying 2% interest. So 5,000 versus 19,000 to get to the same number. Like now, put in numbers that you actually might use, like saving like 20, 40,000 a year, and all of a sudden the discrepancy becomes much bigger. So the earlier you invest, the better. Unfortunately, in medicine, we're all behind the 8 ball, and so it becomes critically important. So it becomes even harder to get there without taking advantage of the returns that you would get from long-term investing. Now, what I will not be talking about here is day trading, stock picking, things like that. We're not talking about like how to try to make money off of this on a day-to-day basis. We're talking about how to invest the money that you are putting aside toward retirement that you're going to use in 20, 30, 40 years. Because day trading fundamentally, like as an individual retail investor, it's not gonna pan out, unfortunately, unless your name is Warren Buffett, and then you have a very different strategy. So primarily what we're gonna focus on is long-term investments, how to manage, how you can invest your money in for retirement specifically. So we are not covering real estate. That is a whole thing in and of itself, and honestly ends up becoming a second job. Cryptocurrency is a speculative investment and really not worth your time, particularly for retirement. Anything speculative in general, basically something where you're like, I bought it at this price and I think someone down the line will pay me more for it without any change intrinsically in its value. That's not really a long-term investment strategy. I'm also not covering specifically retirement planning and accounts, like we're specifically focused on investments for this talk. But just to kind of clarify, because I think this is a common misconception, people will sometimes think like, oh, I have money in an IRA, or I have it in a 401k, 403b, some type of retirement account, and they're good. The thing is those are just accounts. Those are places to park money that have specific tax advantages for doing that. But you have to decide what to invest your money in within that account. So just having your money in those things doesn't mean that it's invested. It's what you do with the money once you put it into that account. That's the question that we're trying to address today. So we'll get more into sort of like, retirement accounts, what they mean, tax implications in my next talk in April. But for now, we're going to focus on once you put it in the account, what do you do with it to kind of invest it in a reasonable way? Okay. So for those who are here, I have a few questions for you just to get a sense of where we should go with all of this. I kind of covered in general what I'm hoping to cover today. Are there any other topics that you want to make sure that we talk about, or any specific questions that you had sort of coming to this talk? All right, well, again, if questions come up as we're talking about anything, feel free to put them in the chat or stop me at any time. Out of curiosity, does anyone have money invested? Do you have money in investment accounts? Is it invested in some way already? Is it something that you have some experience with? How to maximize retirement accounts, IRAs, going from a resident to an attending. So I admit that we won't, other than the fact that you should preferentially put money in retirement accounts first. That would be the general recommendation. What we're going to focus on more is like how to invest it once it's in those accounts. Okay, so one person says they have an IRA, and so they have some money in there. Out of curiosity, for those of you who do have money invested, are any of you using a financial advisor or had someone kind of tell them what to put their money in? Okay, yes, because my husband had one. Fair. It's usually word of mouth that a lot of that happens. I'm hoping it's not someone who's with Northwestern Mutual, because I find that that's like the most common one, but well, that'll be the subject of later debate, but anyway. So the reality is that like, if you learn the basics of this, you can do this on your own. It is not terribly complicated, but I understand that if you want someone to double check your work, That's perfect. I think that's reasonable, but I think having a basic understanding of what your money is invested in, why this works, what the data is behind it, I think is important as you're trying to navigate all of this. So I'm going to start with kind of the take-home message here. The first thing is, whatever your investment strategy is, you need to determine an asset allocation, basically how much you have invested in stocks, how much you have invested in bonds that fits your risk tolerance. Are you going to be able to stick with that through thick and thin, through all the jumps that the stock market is going to go through and all the ups and downs? You need to save enough. At least 20% of gross income is probably a reasonable place to start as an attending. And the basic strategy to follow is investing in passive index-based mutual funds according to that allocation. And then the final point is, you got to stay the course. You got to be able to stick with this regardless of what's happening in the short term, because at the end of the day, who cares what happens to the value of your stocks in 1 year, 2 year, 3 years if you're not going to touch them for another 30, right? There's plenty of time for the market to recover and all of that. And so it's really important that regardless of the strategy that you choose, that you're going to be able to stick with it as the market goes up and down. The people who end up losing out, the people who really lose money on this, it's because they sell at market lows. It's because they get scared and can't hold to their plan. So hopefully the better you understand all of this stuff, the easier it is to kind of hold to whatever allocation you have and not sell at market lows and when the price of everything looks bad. I really encourage you all, again, to read up on this stuff yourself. The one PDF I kind of point to for people thinking about like retirement and investing for retirement is this. If you search in Google, If You Can PDF, it's one of the first results. It was written by William Bernstein, who was a neurologist turned financial advisor, but it's 15 pages. So I assume most people on this call can read something that's 15 pages if you made it this far in your career. And it makes it's a very simple message, and it has a lot of recommendations for some really good books on investing that I think are really good and worth your time if you're interested. So we said we're going to talk about a few investment vehicles. Let's start with bonds. Bonds are probably one of the more straightforward things, but I think it's worthwhile to at least understand what you're investing in if it's part of your portfolio. So bonds are interesting in that, I think unfortunately all of us are very used to being debtors, getting money lent to us from another entity because, college, medical school, all of that. Bonds are basically the opposite. You're actually loaning money to some other entity. So you're lending money to someone. It could be a company or a government primarily, and that entity pays you back in interest. If you hold it to maturity, you get the face value back. So what does that mean? Face value means the amount of the loan. So if a company sells you a bond with a face value of $10,000, that means you are giving them $10,000 up front. The coupon or yield is the interest rate. So if you gave them $10,000 and they said the yield is 5%, that means every year they're going to give you 5% of 10,000, which would be $50 a year, right? So basically they're giving you interest on, $500 a year. They're giving you the interest payment for the privilege of you having lent them money. That's why you would lend them the money in the first place. The maturity date is the length of the loan. So if a bond is a 10-year bond, then the expectation is they're going to pay you back that $10,000 in full at the end of 10 years. And so unlike loan payments where you make the payments, you pay up toward the total value of the loan over time, the way that bonds work is you basically get interest payments over time. So you get that $500 every year if it's a 5% on 10,000. And then you would, at the end of 10 years, the company would then pay you back the full $10,000 on top of that. Okay, so that's sort of the basics of how a bond works. So the question comes around, like, how do you determine the yield? What's a good yield on a bond? And so what that really is primarily dependent on is the likelihood that the company is going to default, right? So if a company like Apple puts out a bond, you're fairly confident they're going to be able to make those interest payments, that they're going to be around in 10 years to pay you back the full value of the loan that you gave them. So they don't really have to offer real high interest rate because it's a relatively safe bet, right? So they might offer a yield of 1 or 2% versus like super sketchy company guy down the road is like, hey, if you loan me $1,000, I'll pay you 10% every year. The reason he has to do that is because, you know, there's a pretty high likelihood that maybe he's not going to be around in 10 years to pay you back the full value of the loan that you gave him. So, you know, companies that are more distressed, that are less stable, less likely to be around for a long period of time, they have to offer a higher yield to entice you to lend money to them. And so usually the yield that a bond offers is related to sort of how stable a company is, how likely it is that company will be around for the duration of the bond. So how do you earn money if you own a bond? One is the interest payment, right? So if if again, $10,000 bond, they're paying you 5% every year. So you're making $500 every year from those payments, right? But the other way you can make it is selling the bond, right? So they took out the loan from you, but say someone else is like, hey, I want to purchase that bond, I want those interest payments. They could buy the bond from you, and so then the company would then have to make payments to the person who bought the bond. So you could potentially sell the bond at profit and make money that way. So what changes the value of the bond? Changes in the prevailing interest rate. And so, for example, if a bond was paying at 5% per year, but the prevailing interest rate dropped to like 3%, and the bonds on the market were offering on average 2 to 3%, well, the value of your bond that's paying at 5% is now higher because you can't get that on the market anymore. And so therefore, if you were to sell it on the open market, the actual value of the bond selling it to someone else would be higher. The opposite happens if interest rates go up relative to your bond. So instead, you have a 5% bond, but now you can easily get one on the market for 7%. Well, now the value of your bond goes down because no one's going to want to buy it if they can just go out into the open market and just get a bond at a 7% interest rate. And so that's what we call interest rate risk. That for a bond that you own, the value of the bond will fluctuate depending on prevailing interest rates. So the main sources of risk when you own bonds are twofold. One is the default risk, right? How likely it is that the company will still be around to pay you back that bond at the end of the term. And interest rate risk. Is the interest rate going to go up compared to the yield that you're getting on the bond, or down? So those two things are going to affect the value of the bond. However, since your stake here is the loan, it's not the company itself, right? So if the company goes out of business, yeah, they're not going to be able to make their payments anymore. But regardless of how the company is doing, as long as it's in existence and able to make those payments, they are required to continue making those payments. So even if the overall value of the company goes down, the value of the bonds that the company has issued don't change, right? And so it's less risky than owning part of the company, which is what you do with stocks, and therefore the overall risk comparatively is relatively low. So we consider this sort of the lower risk part of your investment portfolio generally. Now, just a few words on the current bond environment. Unfortunately, as I kind of alluded to before, we're in a pretty high inflation environment right now. Interest rates are going up, so it's likely that bonds will go down in value over the next few years. I think there's some people have questioned like how much you should have in the way of bonds in your portfolio. Some people have questioned having bonds at all. I think that's probably a bit extreme. Like a portfolio mix of stocks and bonds has been kind of like the way to go for a long period of time. And at least data from the last century shows that a relatively reasonable mix of stocks and bonds will generally help you get to where you need to go. And the bond part will smooth out volatility, basically how much your portfolio goes up and down over time. So I wouldn't eschew them entirely, but I will say that information is out there, and there are questions about like the environment that we're going into for bonds over the next 10, even 20 years. Federal I bonds, if you happen to have heard those were a recent invention, have come in vogue. They're basically, so those of you who may have gotten like savings bonds back in the day from your grandparents, it's a similar idea. It's basically like, so it's a bond like any other. It's a loan that you're giving to someone else. And in this case, the lendee is the government. And so generally you don't have to worry about the government defaulting, fortunately. And so what they're offering within I bonds, it's inflation, is basically the interest rate will be set always at the prevailing rate of inflation. So right now, I bonds are actually paying at 7%, 7.12%. And that rate will change depending on the prevailing rate of inflation is calculated by the CPI, or Consumer Price Index. So it's kind of a way to put away some money that's not going to be eaten away by inflation. There are some restrictions on it. There's a few details that are worth going over. But what I would say is that, like, you can only put up to $10,000 a year into it. You have to buy it directly through the Treasury Direct website, and you have to kind of track it through there. There's no other way to do it. It's a reasonable way to sort of put aside cash that you're not really sure of what to do with, I think. Should it be like a huge part of your portfolio? And I worry a little bit about that, but it is, given sort of, that it will at least keep pace with inflation. It is a very safe place to put money if you need to allocate money to kind of a safer part of your portfolio, if that makes sense. So if you have questions down the line about I-bonds specifically, we can kind of talk about that later. But any questions about bonds in general, or anything that we just spoke about? All right. So the next part of this, we're going to focus on stocks. And I think this is what often people think about the most when it comes to investing. And to be fair, like, it's probably the part of your portfolio that's going to be responsible for a large part of the growth over time. So what are stocks? Fundamentally, it's part ownership in a company, right? So if you buy stock in Apple, you have bought if you buy one stock in Apple, like, you essentially own one millionth of, I don't know how many shares are outstanding, but basically, like, you own part of the company, and your share of ownership is determined by what percentage of the total stocks in the company exist, right? Where do they come from? Well, you may have, if you've encountered the terminology IPO, or initial public offerings, what you may have seen is there are companies that were initially private that then offered part of the ownership of the company to the public. And the reason they do that is to buy into it, they have to pay the company money to become part owners. And so what happens is the company takes that money, and now they have it as cash on hand in exchange for the ownership that they're selling to the people who buy the stock. So it's often a way for the company to raise money if they're looking to expand. So the question is, how do you figure out the price of a stock? For anyone who's ever looked at the stock market before and looked at tickers, you've probably seen, like, these price fluctuations occur over time, and, like, it goes up, it goes down, and it may not be exactly clear why. And so the answer is that this thing happens in the market called price setting. And so fundamentally, in theory, the value of the stock is based on things that are kind of tangible, like reported revenue, how much money the company is making, what their expenses are, how much cash on hand, like, how much money are they bringing in, what's the value of that. The second part of it is number of stocks offer what they call dividends. So as part of a benefit for owning the stock, they say, like, well, if we make profit for whatever profits we make this year for being part owner of the company, we will give you X% of the profits, depending on how many shares that you own, right? So that's what a dividend is. They're basically letting you share in the profits of the company. But another thing that goes into it that is really kind of intangible are predictions about future growth, right? And so a good example of this is Amazon. For years, Amazon did not make any money, right? It was consistently running in the red, but people kept buying the stock, and they wanted to be owners in the company because they thought that in the future, there would be a positive revenue stream, that they would obtain assets, that they would dominate the marketplace, which they fundamentally have. And so people were willing to pay a higher price for that stock, even though they haven't demonstrated a positive revenue stream or anything like that. So how well people think a company is going to do down the line really factors in a lot to, like, the day-to-day price that people are willing to pay for part ownership in that company. All of this information is required to be made public to be traded on US stock exchanges. So in theory, all of this is out there. You could look it up for any individual company, like their earnings and their expenses and their balance sheets and all of that. Because if you want to be traded on the US stock market, that's part of the rules, that you provide all this information publicly. The day-to-day price of the stock is literally determined by just whatever people are willing to pay for it. And so I don't know if anyone's familiar with this movie, Trading Places. It's a classic. Would really recommend you watch it at some point. It's hilarious, but anyway. But essentially, if this is sort of what used to happen, still kinds of happens on the trading floors of, like, the New York Stock Exchange and whatnot. But basically, like, if you say, I want to buy a share of Google or Apple or whatever, you talk to a stockbroker and you say, I want to buy 100 shares. The current price is this. I'm willing to pay let's say, okay, I want to buy 10 shares of Google at 100. So your broker takes that to everyone else who owns shares of Google and says, like, hey, does anyone want to buy it? Is anyone offering selling shares at 100? And they talk to a bunch of people and they're like, well, no, I want to sell it at like 110 or 115. And so your broker tries to figure out like who's offering it closest to the price that you want to pay for it, right? And to be fair, like the price you're probably going to look for is probably going to be whatever the price is documented right now, like the last sale price. So if you see that price kind of updating, if you ever look at stock tickers, like basically every time it updates, a transaction occurred for stock shares at that given price. And so that's sort of what that's the job of the broker, is to figure out like who and come to an agreement on the price for the amount of shares that you want. And so the price changes with every trade because there's always a little bit of what we call a bid-ask spread. Basically, the person buying the stock wants to pay one price, the person selling the stock wants to pay another, and they find somewhere where they agree. Realize the average stock undergoes like tens of thousands of trades a day. And so this happens a lot. So things can fluctuate very, very quickly over the course of a day. So how do stocks earn money? Well, the first and most obvious way is dividend payments. So if the company does well and they pay out a dividend for the profits that they make, well, then you're getting that just as money. Like they just give that to you, that's a check, you're making money that way. But the main way that people think of making money off of stocks is usually by selling them, by saying, okay, I've bought stock at a company, it's gone up in value, people think there's high predictions for future growth, and so people are willing to spend more, pay more for it, and I sell it at a higher price. So increase in value, the company should in theory correlate with increase in stock price and how much people want to own stock in that company. If you ever heard the terminology buy low and sell high, this is exactly what they're referring to. And so they'll say, like, the way you make money off of stocks is choosing the right ones. You choose companies that are undervalued relative to their price, and you hold on to them until people realize that it actually is doing well, and you sell it at a higher price. So the problem with that is that, as you heard me mention before, basically all of the information about the financials of the company, if it's traded on the stock exchange, is public knowledge. And so it's hard for you to have more information about a specific company compared to the rest of the people in the market. The only way to do it usually is by insider trading, meaning that you work for the company or have sources inside the company that tell you something is about to happen that the public doesn't know about. Now, the problem is that's called insider trading, and that's strictly illegal. So don't do that. That will get you kicked off of the stock exchange, and then you won't be able to participate, period, which would be a problem. Unlikely anyone would find themselves in that decision, but I put it out there. But so the thing is that, like, in theory, the only way for you to like buy a stock at a relative discount is because the person selling you the stock knows less about the company than you do, or the industry or whatever. And it is incredibly unlikely that is in fact the case. And so there's this concept called the efficient market hypothesis. The current share price of a stock reflects all available information. So buying an undervalued stock or selling at an inflated price is impossible because everyone's working on the same exact information. Now, is that strictly true? No, there's plenty of people who participate in the stock market that really don't know what they're doing, but on the whole, because of all the other transactions that are occurring that cause price setting, it is just it is incredibly unlikely that you individually are going to have specific information about a stock or a field or an industry that doesn't exist relative to the rest of the market that is also looking at and evaluating that stock. The other thing that kind of goes against this is that, realize that up to like 85% of trades of any individual stock on a daily basis are through institutional investors. So like companies that with names like Goldman Sachs or Bear Stearns or similar. And so what they will do is they have people whose job literally is to just, watch the market. And B, for industries they may not have as much experience with, they hire consultants. And so I really caution people in medicine. You may think that you have an edge in trading like stocks related to medicine, like BioNTech, for example, people were like, oh, they're developing an mRNA vaccine. I'm in medicine. I know this somehow no one else does, so I should buy it now because people are undervaluing this. The reality is that like all of the major investment companies have people who know about this stuff, who they are consulting as they're making decisions about which stocks to buy in every single industry. So the reality is and that is their only job. So if you think as an individual investor that you somehow have specific knowledge that the rest of the market doesn't, you are absolutely fooling yourself. Like doing this 5-10 minutes a day, you're gonna do better than someone who does this for their career. The answer is no. And so the question that should come up then is, well, if I'm not doing this all day, and I know that there are companies that are good, and I know there are companies that are bad, how do I figure that out? If I can't do it, can someone do it for me, right? Can an expert pick stocks for me? So the answer is probably no. So interesting study, an advisory group kind of evaluated their own stock market predictions. And so they looked at overall like over 6,500 stock market predictions across 14 years, and 68 of these like gurus, like this is their job, is to pick stocks, right? Like they are hired to do this. At the end of the day, in terms of their positive predictive value, like how often were they right about the direction a stock would go, it was less than a coin flip. It was 47.4%. So realize that these are people, this was their entire job. They were considered experts in picking stocks, and they weren't better than flipping a coin as to which way the stock would go. So you can't do it, experts can't do it. And so the answer is, as far as like picking individual stocks, for most people, it's like throwing darts at a dartboard. It's unfortunately, it's a loser's game. The likelihood that you're going to make money that way is pretty darn low. And so the overall conclusions here are that picking stocks doesn't work. So how do you invest? So I said in the beginning, like you're going to have to invest. A large part of your portfolio is going to be in stocks. So what do I mean? The answer is to own the entire market. So instead of picking one or two individual stocks, you just want to own the entire market. You want to own everything, because on the whole, the market has gone up, right? And so overall, GDP has grown for the United States. Overall, all the companies that, if you look at sort of the overall economic output and the value of all of the companies in the US over time, that has clearly gone up over time. And so this is a graph of the S&P 500. What that is Standard & Poor 500, which is the 500 largest companies in the US at any given point in time. And if you look at the value of owning all of those companies relative to their market cap and how that trends over time, the clear answer is that it clearly goes up. Now, as we'll talk about, there are large fluctuations. You can see here the dot-com bubble in 2000 and the housing market crisis in 2008. But the overall trend still is that that investing in stocks is generally considered to be a relatively reasonable proposition over long periods of time. Now, the problem is in any given year, there can be dramatic shifts. And so what this is showing is the percent change in the S&P 500 for any given year between the 1920s all the way to the late 2010s, up to 2020. And you can see that overall, in most years, the value of the S&P 500 goes up. But there are years where it drops 50%, it drops 40%, it drops 30%, and that happens within the year. So all of a sudden, the value of, if your portfolio is primarily invested in the S&P 500, can suddenly tank 30% in a year. So that's a lot. So there's a lot of volatility that you have to deal with, but overall, the trend is toward increase. And another way to look at that is if you just look at rolling returns. So say you own the S&P 500 for different years, the highest return over a 1-year period was 60%, the lowest was -40. But you see, the longer you hold it, the more likely it is that the overall outcome is positive. So once you get to 15 years, 20 years, there is no 15-year period between 1972 and 2010 where if you held the S&P 500, you had negative returns. You always had a positive return on your money. You can see the overall positive returns also trends down over time, and it kind of, so the negative and positive kind of get closer together. But overall, the average, so the average rate of return of the S&P, annualized rate of return of the S&P 500 from 1920 to 2010, it's about 10%. And so the 20-year high for rolling returns was 18%, the 20-year low was 6.4%. So even in the worst 20-year performing period of the S&P 500, you still made 6.4% per year, which is far more than you're going to make with any other, with many other sort of investments over that kind of time frame. So that should bring up the question of, why does the market increase in the long run? Well, inflation's one thing, right? So in theory, the value of like what people are willing to pay for stuff, if inflation goes up, will also change intrinsically the value of the company. So there's built-in inflation protection in the stock market, right? So if there's inflation, companies will make more money because they're charging more. And so you're kind of protected in that way. Population expansion, so more people need goods and services, and so the economy expands, and therefore the overall value of the companies in that economy goes up over time. Improving productivity, we've certainly seen a lot of that change in our own lifetimes with rapid increases in technology. And so as you can get more work from fewer people, you're able to do more, and therefore the overall value of the economy goes up. And then innovation, again, like going back to that technological innovation part, like, you know, there are new markets that didn't exist now. Like social media was not a thing, you know, 15, 20 years ago. And now it's an entirely new market that brings its own economy and adds value to the economy as a whole. And so owning the market is kind of the way to take advantage of all of these larger forces and being able to invest in the market as a whole. You get to reap some of the benefits by part ownership in all of the companies that do this. Now, is it realistic to be able to buy every stock in existence? No, like that would be kind of a pain in the butt to kind of manage all that, right? Like there's over 2,000 companies that participate in the US stock exchange. There's a whole bunch in international stock exchanges that you'd want to have part ownership in as well. And so the question is, well, is there an easy way to do it? And the answer is yes, it's called a mutual fund. And so what is a mutual fund? So a mutual fund is basically represented by this. You have investors, they pool their money together in a mutual fund, and the mutual fund invests in some combination of stocks and bonds or other investment instruments. When that increases in price or dividends are paid out, that gets paid back to the fund, which then gives it back to the investors that pooled their money together. And so one way to think about this is that if a mutual fund that purports to follow the total market, like is a total US market, a stock market fund, basically by putting money into that, you now have part ownership of all of the stocks in the US stock market, but you don't have to do it yourself. The mutual fund's kind of doing the back end part of it. You just own a fraction of whatever the mutual fund owns based on how much you paid into it. Now you get paid a fee for doing this, right? Like this takes a little bit of work, and so they take part of it. And so there's something called an expense ratio, usually for passive funds on the order of 0.15 or 0.1% per year. So a way to think about it is if you had $100 invested in that fund, you would owe the fund itself about, if the expense ratio was 0.1%, you would owe the mutual fund 10 cents a year for every $100 that you have invested in it, right? And so that's the fee that you're paying. So it should be relatively low compared to the amount that you're investing. Now, then you get back to the question of, well, okay, what mutual fund do I invest in? And what people will try to convince you of is, well, why would you invest in the entire market when there are some stocks that are good and some stocks that are bad? You should invest in my mutual fund because I know what I'm doing and I'm going to pick the right stocks for you and exclude stocks from the fund that you shouldn't be investing in. And so that should already sound kind of wonky to you, right? Hopefully, if you believe me on the you can't pick stocks rant that I went on. So, you know, what they're trying to sell you is that they can predict the future, right? That they know exactly which stocks are going to perform and which can't. At the end of the day, I can tell you their crystal ball is cloudy. Active managers, so when we talk about active management, what it means is that the mutual fund is picking what stocks to put in and which ones to exclude based on their own sort of expertise. There's a good study from 1997 looking at sort of performance of mutual funds. They analyzed almost 1,900 mutual funds between 1961 and 1993. The average actively managed mutual fund underperformed just a passive fund following the S&P 500 index by 1.8%. And here's the other problem. The typical actively managed fund expense ratio is on the order of 0.5 to 1% per year. So think of it this way. If your returns are 7% and your expense ratio is 1%, then really the returns that you are going to see are actually 6%. You have to subtract your returns from whatever fee you're paying to get them. And so if you're already underperforming the S&P and you're paying a fee on top of it, you got a problem, as I'll show you later. So what do experts on this say? So Jack Bogle, who unfortunately passed away the other year, who's the father of like passive index fund investing, of the 355 equity funds in 1970, 233 of those funds have gone out of business. Only 24 of that entire group outpaced the market by more than 1% per year. That's kind of terrible odds, right? You know, what are the odds that you found like the 8%, you happen to pick one of the 8% of funds in that time period that happened to do well? Warren Buffett, a low-cost index fund is the most sensible equity investment for the great majority of investors. My mentor, Ben Graham, took this position many years ago, and everything I have seen since convinces me of its truth. And so, as I was kind of alluding to, like, you know, you look at an expense ratio, and if the expense ratio is 1%, you're like, oh, well, I'm only paying them $1 for every $100 invested, and that doesn't seem so bad. It seems like a really small slice of the pie. The problem is you shouldn't look at it as how much money you're paying them each year. You should look at it as how much that percentage eats from the percentage of returns that you're getting. And so here's how to look at it. Let's say you're investing $40,000 a year, you end up with an annualized return of 7% over 30 years. And so if there's no expenses, you will end up investing $40,000 a year over 30 years with $3.8 million, right? But if I invest in a fund that is costing me 1% per year to own and the return is 7%, then my return after expenses is only 6%. And since now my return is only 6%, the amount of money that I end up with after 30 years is now $600,000 less. It's only 3.16 million. And so that is the difference that a 1% increase in expense ratio has, because it's not that, oh, I'm only paying like 40, you know, if I'm investing $40,000 a year, I'm paying, you know, 1% of that or $400 of it. It's that you're subtracting from your overall return effectively. And so the magnitude of effect over time is actually very, very large. So small expense ratios by 0.1 aren't going to have as much of an effect, but 1%, 2%, like 2% expense ratio with the same return, 5% return after expenses, over $1 million less over 30 years. So these small percentages have huge implications in terms of how much you end up with at the end of the day. Now, put on top of that, that you actually have no idea with an actively managed fund, like if they're going to outperform the S&P 500 or if they're going to do worse. And on top of whatever their actual return is, you're paying a higher fee to do it, right? Because they're doing stock picking and you're paying them for their expertise. So if you're paying 1%, their return's 5.2, and now your return after expenses is 4.2%, you're potentially out 1.4 million compared to if you just invested in a passive index fund. So all of these small things, all these small expenses really, really add up. And the question really is, do you feel lucky? You know, maybe 5 to 8% of the actively managed mutual funds will in fact outpace the S&P 500. Do you really feel lucky that you're going to be lucky enough to pick one of those and that it's going to outpace the S&P 500 by more than its expense ratio? When it comes to my retirement, my answer is no. I'm going to take the safe bet. I want to know that I'm going to be okay in 30 years. So that's my general recommendation on it. Other fees to avoid, if you happen to buy funds through a financial advisor, sometimes they'll make you buy into load funds, which is literally all it is you're paying your advisor a commission for the privilege of investing in the fund. So if you've heard of things like Class A, B, and C shares, where you have to pay like 5% of whatever say you're buying like $10,000 of a fund, you have to pay 5% of it or $500 just to buy the fund. There is zero reason you should ever do that. First off, they're probably selling you an active fund, in which case you already know you don't want to do that. Second off, if it's a passive fund, you don't have to do that. You can find the equivalent without paying a load fee. So you should never have to do that. Other fees that sometimes you'll come across are 12B-1 fees, which are just advertising or marketing costs for the fund. Again, there's never a reason to pay that. You can buy passive index funds without having to go through any of that. And so anytime you interact with the financial industry, I can't emphasize enough that they basically exist to take your money. You have to interact with them to buy these products, but you should keep your interactions to the minimum, and you should really try to make sure that you're going in there knowing what you want and not just listening to whatever they're doing, because realize that if they have a financial stake in your decisions, odds are they're going to do whatever lines their pockets the most, right? And with investing, as I showed you with the different sort of scenarios in terms of expense ratios, you really get what you don't pay for, right? The lower the fees you have, if I can't pick stocks, if I have to rely on market returns, the only way to increase your return is to reduce the amount of fees it takes to invest in the market by picking like the funds that have the lowest expense ratios, which passive funds by design, since there's no stock picking occurring and have lower turnover, will have generally the lowest expense ratios. So in summary, what do? You buy passively managed index-based mutual funds at the lowest cost you can. So, and the three main funds that you'd be looking at are one that follows the total US stock market index, one that follows a total international market index, and one that follows the total bond market index. People talk about diversification. If you own those three funds, you literally own all of the stocks in the world and the entire bond market by just owning those three funds. So diversification doesn't mean that you own a whole bunch of different things, that you own a whole bunch of different investments. It can mean that you just own these three things and you own most of the investable stuff in the world. It's simple as that. You want to buy and hold these funds in your retirement accounts and then sell them when you need for retirement income 20 years, 30 years, 40 years down the line. When we talk about investing, well, let me stop there. Questions about stocks, mutual funds, what questions come up from that? So are these passive funds still managed through companies like Vanguard? Yes. So Vanguard sells them, like Fidelity, Charles Schwab, like they all have, like someone has to manage the fund, right? Someone's doing the investing in the actual stocks with the money that you give them. And so that's sort of the purpose of the company, is to do that part of it. And so, yes, and you get to choose kind of where you do that. We'll talk about a little bit how to do that later, and why I tend to have a preference for Vanguard. When you recommend buying the total market, do you include international? So typically, there are total world market indices, right? Like mutual funds that literally just follow the entire world index, so US and everything else. Since most people like to fiddle with, like, you know, what percentage of their portfolios in the US and what portfolios international, most people will own a US total market index and an international total market index. I will say by market cap, like 55% of the total like value of companies in the world is in the US, the other 45% is international. And so a total world index would be 55%, 45%. Most people advocate for like an 80-20 or 60, somewhere between 80-20, 60-40 US international split. No one can really convince me that anyone knows exactly where along that split it should be, but the answer is you probably should weight a little bit more toward the US, just because there's something called currency risk that you take on when you own international companies, right? Because when you buy that, you have to buy in the original company's currency, and if the currency fluctuates, that will change the price, even if the company hasn't fundamentally changed. So people tend to recommend weighting your own country, so the US in our case, in terms of like where your equity allocation is. But you could, in theory, just buy a total world index and be done with it that way. All right, good questions. So I alluded to in the beginning something called an investing policy statement. What that is what are your goals and how do you intend to get there? And so like my example here, if we're talking about retirement, like you want to set pretty specific goals, right? So our investments will provide an income of $100,000 a year, and you have to say like what year you're talking about, because we talked about inflation's a thing, of $100,000 per year in 2019 dollars, with a goal of achieving financial independence by whatever date. So, you know, you want to retire. The question is like, how much do you want to retire on? Like, how much do you expect to spend in retirement? And how many years do you want do you think you're going to need to get there? So that should be written down. And then the other part, another thing is like, how do you intend to get there? How do you intend to invest? And so, for example, we will primarily invest in passive index funds with an allocation of 75% equities or stocks and 25% bonds, with the equity allocation divided into 80% US total market and 20% international. And so that would be an example of how you could do it. You obviously would need to come up with the numbers that you are comfortable with for this, but that would be sort of a basic framework of how to think through how to create this allocation. Risk tolerance, stock performance, as I talked about before, from 1920 to 2010 has 10% annualized, average annualized returns. Bond performance has fluctuated like 4 to 5%. In some periods, it's been much lower in other periods, like the one we're living in right now. So these numbers obviously fluctuate over time. I'm just giving you sort of like the longer term look at this. Savings accounts, unfortunately, we're down to 0.5% these days, but it's unlikely savings accounts are going to do much more than 1 or 2% historically. So stocks obviously have a lot better like long-term returns, although there are historical periods where bonds actually outperform stocks. Stocks also have much higher volatility compared to bonds. The price of stocks fluctuates dramatically day to day. I kind of showed you from like those different yearly returns on the S&P 500. And so the question is, when you invest money like this, can you avoid selling when, not if, when your portfolio drops 50% in value? Because I guarantee you during your investing career, you're going to see at least a few market corrections where the price of your stocks tanks 10%, and probably one true like bear market where it drops 30% or more. And so I just picked out the last 5 years for the S&P 500. And so as you can see, like things were okay. There's a little bit of a dip in 2019 that recovered relatively quickly, as this was the start of the pandemic, and all of a sudden the value of everyone's US market index tanked 30%. And so there are a lot of people who sold here and they lost their shirts when they did that. But if you held on to it, you see that there was a lot of growth and recovery that occurred. And then, so this is where we're at now. We started here in 2018 with a value of 22,097, and you end here at a value of 4,514 for the total S&P 500. So over longer periods of time, again, this has been a pretty crazy period for returns for the S&P 500 in general. But I mean, there's already been another market correction that occurred recently here. This was a 10% dip. Like people were kind of freaking out about this the other day. Like this was only last week. And so, you know, if you have a lot invested, like that could mean like a 6-figure drop in the price of your total investment portfolio. And so you have to be able to hang on in when those things occur, because it's not an if, it's a when. And you really, again, the question is, how do you keep yourself from jumping out the window? So this is like from old films around like the Great Depression and whatnot, where the stock market tanked 50% in a day. And so again, if you take a longer term view here, if you're investing now, who cares what happens now? What you care about is what's the value like 20 years, 30 years down the line, right? Now, the thing, I love this quote. I would recommend reading this book if you're interested. I think he writes about like investing in the stock market in a very approachable way. But there are certain things that cannot be adequately explained to a virgin by either words or pictures, nor can any description I might offer here even approximate what it feels like to lose a real chunk of money that you used to own. Like, I can tell you this all day and try to tell you that, like, look, you're going to see downturns and you just got to sit through it. But like, until you actually go through it with like real amounts of money, it's hard to know what you're going to do in that situation. And so what I always advise people is assume your risk tolerance is not as good as you think it is, right? Don't put everything in stocks, like have some allocation of bonds, go through your first correction and see what you do. If you're able to hold on, if you're like fine, then fine, you can increase your allocation to stocks. But if you are like, thank God I have that bond allocation, so I'm not selling off everything, maybe that's what you need to prevent yourself from doing the wrong thing when those downturns occur. That's really a question you can only answer for yourself. And then the other thing is that, you know, while these downturns occur, it's kind of interesting. Like if you own stock, you're not happy about it, but think of it this way. I'm going to buy hamburgers the rest of my life. When hamburgers go down in price, we sing the hallelujah chorus in the Buffett household. When hamburgers go up in price, we weep. For most people, it's the same with everything in life. They will be buying except stocks. When stocks go down and you can't get more, and you can get more for your money, people don't like them anymore. So you have people who like, there's a huge downturn in the price of stocks and they're like, oh, you should sell and like buy this other investment instead. But the thing is that like, we know that the most likely thing that's going to happen is the market will recover if given enough time. And now I can buy stocks at a discount. So why wouldn't I buy more stocks, right? So because if I assume that the return is going to be better, I want to buy them. I want to buy low and sell high, right? So I don't know when those downturns are going to occur. I can't predict it. I can't predict what the bottom is when a downturn occurs either. So I can't like wait, right? Like you want to be investing along the way. Time in the market beats market timing every time. But you can kind of get there by doing something called rebalancing. And so what's rebalancing, right? So say you had a portfolio that was 75% stocks and 25% bonds. And over the year, your bonds increased in value and your stocks decreased in value. So if you wanted a 75-25 split, and then at the end of the year, you were at a 70-30 split, you would say, okay, well, I want to keep this allocation. And so what I'm going to do is sell some of my bonds to buy stocks to get back to this. Fundamentally, what you're actually doing there is you're buying low and selling high, right? You're buying more of the underperforming asset and you're selling more of the higher performing asset, right? So you're selling the thing that increased in value and buying more of the thing that decreased in value to keep the overall allocation the same. And so this is also important if you're thinking about like trying to maintain a specific allocation, because if you never rebalance, we know that over time stocks are going to outperform bonds. The rate of growth of stocks is always going to generally be higher than the rate of bonds. So if you want to keep your allocation the same, 50-50, 60-40, whatever, you're going to have to rebalance from time to time, right? Buy one and sell the other. If you don't, then the value of your stocks will go up over time, the value of your bonds will, but the stocks are going to outpace your bonds and your overall allocation is going to go out of whack. You're going to be mostly stocks over time. And so if that's not congruent with the amount of risk that you're willing to take on, you really should be rebalancing over time to keep your allocation at a risk level that you can tolerate. Does that kind of make sense? Okay, at least one yep, so that's a good start. Okay. And so say that you're feeling kind of lazy and you're like, well, rebalancing, that could take time. I don't really want to deal with it. The good news is that there is an investment vehicle for you, and that is called a target retirement fund. And so it's a mutual fund, but instead of it investing in just the US market, just the international market, just in bonds, it invests in all of those things for you. And so this is what's called the glide path for like one of Vanguard's like target retirement funds. And here's what it is. So the red portion represents the US stock portion, the yellow portion represents international allocation, and blue is bonds. And so depending on how far you are out from the target date, so say it was like target date 2055, then if you're 45 to 25 years out, it's going to be 90% stocks with this split and 10% bonds. As you get closer to it, what it's going to do is, and it'll automatically rebalance year to year. So if the stocks start to outperform and the bonds go down in value, you're going to sell some of those. The fund will actually sell some of its stocks to buy more bonds, and you won't have to do anything. It will keep the allocation exactly the same for you. And so by owning this one fund, you literally own everything, right? So as I was talking about before, the number of funds that you own is not diversification, it's what those funds are invested in. And so with one fund, you can own a total US market index, a total international market index, and a total bond index, and it will rebalance for you. And so what they do is that the closer you get to retirement, in theory, as your risk tolerance goes down, because the closer to retirement you are, you should want more safer investments, right? Because you're now more concerned about losing money. And so their take is that you increase your bond allocation toward retirement and decrease your stock allocation, and then they change it over time. Now, is this the exact right way to do it? Is that the optimal allocation or the correct path to kind of like change from stocks to bonds over time? The answer is nobody knows. Some people advocate like don't own any bonds until you're like, a few years out from retirement. Some people say at least 10%. Some people say you should own a higher percentage of stocks at the beginning of retirement to avoid sequence of returns risk and something like that. So there's a lot of different views on this. I can't say one is perfect, but for most of you who are going to be very early in your investing careers, the answer is just save a lot, and probably you should have most of your investments in stocks, at least to start with, which is what most vehicles out there are going to provide if you invest in a target date index. So how do you choose which one of these to invest in and how to allocate? I'm going to tell you, you got to read a little bit. Like, I can give you a general overview of what these instruments are and a general sense of where to start, but this is something I think that is worthwhile doing more reading on. Again, I'm going to reference the If You Can PDF again. He won't point out these two books because he wrote them, but the 4 Pillars of Investing and the Intelligent Asset Allocator are wonderful books if you want to really understand like stocks and bonds in general, sort of in retirement investment advice. I really like to random walk down Wall Street in terms of like looking at sort of stock prices and like, you know, again, pushing passive investing and why that works. I know I'm going to say this and many of you are going to be like, God, I have so much to keep up on from the medical literature and asking me to read more books. No, I'm going to say you have to read something. You can't read 0 things, but you got to read something. But if you want like initial, probably safe advice, own a total US market, total international market, and total bond market. All of these should have expense ratios less than 0.1%. Like Vanguard's total stock market index, I think their expense ratio these days is 0.04%. Determine allocation based on risk tolerance. If you're starting out, like you could start with a 3-fund portfolio, which is literally a third US, a third international, and a third bond. That's probably a little bit safe for someone starting out in their investment career. You could probably do 90% stock and 10% bond, and maybe an 80-20 split for US and international. But you kind of have to, again, can I tell you the exact right way to do this? Nobody actually knows the perfect allocation for, you know, from now to for the next 30 years. But probably mostly starting in stocks is the correct answer, with maybe a little bit of bonds to kind of smooth out the volatility. And if you're like, I really want a hands-off approach to this, then you could just invest in a target retirement fund if the expense ratio is low. Vanguard's target retirement funds, their expense ratio is like 0.15, 0.14, 0.12. So it's certainly a lot less than investing in a truly active fund, but you will pay a little bit more because they're doing a little bit more work for you in terms of the allocation, doing the rebalancing for you over time. Where do you invest? Tax advantaged accounts are going to be the place that you're really going to focus on. Again, we'll talk about this more in April, but you want to really max out the money you put there. And once again, these accounts exist to put money in because you get specific tax benefits for doing so, but just putting the money in there isn't investing it. Once the money is in that account, you have to invest it in something, in some mutual fund, to actually have the money invested. Once you max those out, which should be happening as an attending, you may have to, then the next place to put it is just a regular taxable brokerage account, which just means you can invest in the same things. Often you get more flexibility. The only difference is you don't get any specific tax benefits for doing it, and you have to pay taxes on capital gains. So you want to take advantage of tax advantage accounts where you can, particularly for physicians who are likely to have high marginal tax rates. And if all else equal, if you haven't opened an account with a company before, I tend to recommend Vanguard. It's not because their interface is good; it isn't compared to like some of the other larger companies. But the reason that I talk about Vanguard is that it has a very unique ownership structure. Most companies, you invest in funds. The investment company has private owners and stockholders, and that's the priority for the company, is to make money for them. And so therefore their incentive is to try to make money, as much money for their stockholders as they can. Vanguard is unique in that, so Jack Bogle was the guy who founded it, and instead of maintaining ownership of the company, what he did is he basically turned over ownership to everyone who owns the fund. So you can't buy shares in Vanguard on the US market. You buy shares in Vanguard when you buy one of their funds. That is the only way to own the company. And so as a result, in theory, the company is incentivized to make as much money as it can for the people who own their funds. And therefore, they are incentivized to lower the fees on their funds to the extent possible so that you make more money, right? So it's very unique when it comes to that. Is it perfect? No. Like, then you also have Fidelity now putting out like 0 expense ratio funds. So if you already have a company, if you already have accounts at like if you already have accounts at like Charles Schwab or Fidelity or TD Ameritrade and you're happy with them, you can invest generally in whatever you want, regardless of the company that your account is with. So if you had a Fidelity account and you wanted to invest in a Vanguard mutual fund, you can do that generally without an additional fee. So I wouldn't say this is enough to say you have to change it, because it's kind of a pain in the butt. But if you haven't started an account, it is something to consider at least. How do you know if you're saving enough? Again, my rule of thumb of this is start with at least 20% of your gross pay. Plan on meeting at least 25% of your annual spending. We'll talk about this more when we talk about retirement specifically. If you're curious, you can sort of play with numbers with an online investing calculator, like throw in, I'm investing this much per month. I expect this rate of return and this time frame, and therefore, if I do that, I expect it'll tell you how much you would end up with. That's actually how I calculated all those numbers I came up with before in terms of different rates of return for a given investment amount over a given time frame. And so you can kind of play with different scenarios by doing that. If you just Google like investment calculator, there are many of these online. Where do you put your savings? I always encourage people to start with an emergency fund. 40% of Americans surveyed said they couldn't handle a $400 sudden emergency without going into debt, and that should never be you as a physician. Pay down high interest debt, Roth IRA, Roth 401k, 403b. This is mostly advice for residents. As an attending, you probably want to do traditional to get the immediate tax break. Pay down moderate interest debt, and then after you've maxed out your tax advantage accounts, put it in a regular taxable brokerage account. And so the next steps here, I think, are really, hopefully this gives you at least a little bit of an overview of investing and different things you can invest in and why you should favor sort of a passive approach rather than stock picking of any form. But realizing that there is a lot more to learn here, and I would recommend that you read up on this stuff. So the If You Can PDF, I'll plug one more time. Again, it's 15 pages. It's very straightforward. And I like the fact that it gives like 6 or 7 books for you to read if you really want to sort of go in depth on these topics. So I would really recommend that as a good starting place. The Bogleheads Wiki, Getting Started, like that's a very good, they have like a 10 video series. Each of them are like 3 minutes on like all these various topics on investing that I think is very straightforward and easy to understand. For people really sort of like starting out on this, MD in the Black is really written for residents and fellows, like, very, very basic understanding kind of stuff. White Coat Investor, like his early stuff is good about like just generalities about retirement and investing and all of that. His newer stuff is less useful, but like the core basic stuff is very helpful. And all of you, since you work for Penn State, you have access to a 403b. And so if you're curious as to how to put money in there and to what you can potentially invest in, and you want to look at your investment options, you can do that. If you just set up your account, you don't have to defer money into it immediately, but you could take a look and see what investment options are available and use that as a way to start understanding all this stuff and playing around with it a little bit. So that's all I've got. I'll take any questions if you got them, but I'll stop the recording here.